The Consumer Price Index accelerated at a faster than expected pace in March, pushing inflation higher and likely dashing hopes that the Federal Reserve will be able to cut interest rates anytime soon. The CPI, a broad measure of goods and services costs across the economy, rose 0.4% for the month, putting the 12-month inflation rate at 3.5%, or 0.3 percentage points higher than in February, the Labor Department's Bureau of Labor Statistics reported Wednesday. Economists surveyed by Dow Jones had been looking for a 0.3% gain and a 3.4% year-over-year level. Excluding volatile food and energy components, core CPI also accelerated 0.4% on a monthly basis while rising 3.8% from a year ago, compared with respective estimates for 0.3% and 3.7%. Stock market futures slumped after the report while Treasury yields spiked higher. Shelter and energy costs drove the increase on the All Items Index. Energy rose 1.1% after climbing 2.3% in February, while shelter costs, which make up about one-third of the weighting in the CPI, were higher by 0.4% on the month and up 5.7% from a year ago. Expectations for shelter-related costs to decelerate through the year have been central to the Fed's thesis that inflation will cool enough to allow for interest rate cuts. Food prices increased just 0.1% on the month and were up 2.2% on a year-over-year basis. There were some big gains within the food category, however. The measure for meat, fish, poultry and eggs climbed 0.9%, pushed by a 4.6% jump in egg prices. Butter fell 5% and cereal and bakery products declined by 0.9%. Food away from home increased 0.3%. Elsewhere, used vehicle prices fell 1.1% and medical care services prices rose 0.6%. The report comes with markets on edge and Fed officials expressing caution about the near-term direction for monetary policy. Central bank policymakers have repeatedly called for patience on cutting rates, saying they have not seen enough evidence that inflation is on a solid path back to their 2% annual goal. The March report likely confirmed worries that inflation is stickier than expected. Markets had expected the Fed to start cutting interest rates in June with 3 reductions in total expected this year, but that shifted dramatically following the release. Traders in the Fed funds futures market pushed expectations for the first cut out to September, according to CME Group calculations. There's not much you can point to that this is going to result in a shift away from the hawkish bent from Fed officials, said Liz Ann Sonders, chief investment strategist at Charles Schwab. June to me is definitely off the table. The Fed also expects services inflation to ease through the year, but that has shown to be stubborn as well. Excluding energy, the services index increased 0.5% in March and was at a 5.4% annual rate, inconsistent with the Fed's target.